we're trained and indoctrinated to be in this accumulation game of net worth, but cash flow is the real game. And so if I can unlock assets to provide more cash flow or create contingency plans or show you ways you could spend a death benefit while you're alive, man, it's like we now have improved your life without additional risk.
Garrett Gunderson is a New York Times best-selling author of Killing Sacred Cows, What Would the Rockefellers Do?, Money Unmasked, Disrupting Sacred Cows, among others. He's got 10 books out there. He's the founder of Wealth Factory, a firm focused on helping high-income earners keep more of what they make without budgeting, deferring life, or following Wall Street's one-size-fits-all advice. Why is a 401k a bad thing in your mind?
All right, I'll list it off quick.
Yeah.
This is my time. I'm on the rise.
Hi, I'm Kyle Stevenson, and you're listening to the Assets and Orthopedics podcast. This show is for high-income professionals who want to think like the wealthy. We focus on elevating mindsets, building empires, and creating a lasting legacy. Our goal is to empower you with financial intelligence, long-term strategies, and the mindset shifts necessary to achieve true financial freedom. We dive into real estate investing, entrepreneurship, and wealth-building systems that help you break free from the grind and live with purpose. At Legacy RX, we live by a simple creed. Be bold, embrace the hunt, unleash the beast. It's time to take action, design a life of purpose, and fearlessly pursue the freedom you deserve. Enjoy the podcast. All right, welcome back to the Assets and Orthopedics podcast. This is your host, Kyle Stevenson. Today's guest is one of my favorite financial minds. He challenges conventional money thinking and empowers professionals to build wealth with intention, not sacrifice. Please welcome Garrett Gunderson. Welcome to the show, sir.
I like that, like wealth with intention without sacrifice, because so much in finance is like teaching people to sacrifice, like cut back, reduce, eliminate. And then they live kind of like a mediocre life and they reserve their best life for when they're kind of too old to enjoy it. And, they miss out on all these memories along the way, and you can never buy back the memories you never have. And so it is really important to me to like make sure people understand that philosophy. And I got to be careful. Like, I don't mean to be reckless along the way. I'm not saying, hey, just spend everything that you make. I'm all about financial independence, which is creating cash flow from assets that cover your expenses. Mm-hmm. And when you have that, you have a lot more choice. It's not you're not free if you have independence, but you have choice. Like freedom is just a mindset. It's like a way of being. It's like you can be present. And there's times where I'm free, and there's times I'm least free. Is if I have a cash flow crunch because I've, made some type of mistake, or a business partnership that isn't going according to plan. Those are the two biggest risks to my freedom, because otherwise I'm pretty free and I'm pretty fun. But if those things are going on, so like, it's pretty important to assess like how's this feel free and not free. And there's a lot of people that when the market goes down, they feel no freedom because they're completely reliant on things outside of their control. And filling out of control is a pretty difficult, frustrating thing. I like to invest where I have some influence. I like to invest where I have like contribution and where I can make adjustments. So I know you even asked me a question, Kyle, and I'm just like, going off, but it was cool that we saw each other at the airport not long ago. I think it was like last week. And when you're like, I'm one of Scott Jared's guys, I'm like, oh, you work with Scott. I thought you like 4, but you're a DO and doing a lot of other stuff. And I was like, oh, you're a client of Scott's, who I've known for quite a while now. I think 6 years.
Which is awesome. Yeah, you were at the Salt Lake airport. We saw you. We were flying back from Whistler, Canada. I was hanging out with some guys talking about being your own bank and infinite banking. Yep. And just so happens I saw you, and I couldn't help but get a picture. And
I like it, dude. My wife always rolls her eyes, but I like it. I'm like, dude, someone read my stuff and I had to get to talk to him. Like I always want people to approach me in an airport or in those kind of situations. My wife brought her best friend once to the airport. We're traveling together, and she goes, just so you know, someone's going to approach Garrett in the airport. And they did. And then they rolled their eyes and kept walking. But I was like, this is awesome. Even better when I got my kids with me, because then my kids are like, oh, that's pretty cool that what my dad writes impacts people. Exactly. I mean, dude, what good is it to just write and not actually get the reward of talking to the person that read it? Mm-hmm. Like, I love that. I love the camaraderie that it could build, and like just the reality that it forms.
Absolutely. Yeah. So, I mean, to introduce myself, I'm an orthopedic surgeon here in Indianapolis, and I love the educating physicians on this stuff, because To your point, we all think like the middle class, sadly. I mean, we have the scarcity mindset, I think, for the most part, to generalize. And so that's why I think this episode with you, digging into your books and digging into your philosophy, is going to help a lot of people.
Yeah, man. I mean, there's a lot that you guys go through to do what you do. A lot. I mean, the amount of school that it takes and residency, and then the demands and the focus, and like, so there's a lot of, paying off loans. There is a lot of time for money, even though it is higher paid time.
Sure.
And so it is a little bit harder sometimes, because I think of what you guys go through with school and residency and how much time it would take to then figure out how to invest beyond that. And then you finally get this payoff with the career. So the fact that you're doing this, I really admire it, because, I've always just kind of been an entrepreneur and I'm pretty much unemployable, but it would be hard if I had like a job and then I was doing this stuff in addition to it and having other things. So but one thing you're showing people is if you commit to it, it's easier than you think.
Mm-hmm.
And I think 80% of what we think we need to know about finance, we don't actually have to know. You need to know the essentials, the foundation, and certain frameworks and philosophies. But I know very little anymore about tax liens. I learned about them 20 years ago. It's just not my investor DNA. I don't do anything in options trading. So I could tell you back in the day about straddles, and I could tell you about, covered calls. I just have nothing to do with it. I know almost nothing about what the stock market's going to do, what it's done. I have $0 in it. What it does is it removes those distractions, and I invest really in two main assets: my businesses and my intellectual property. And I used to invest in real estate. The problem is I don't like talking to bankers and attorneys and property managers and looking in spreadsheets. So the only real estate I own is a hedge against inflation, where I don't want to just store everything in cash value. I don't want to store everything in just my business. So I basically have this property that's got an impeccable view that has had property values go up when others are flat or going down. And I have a cabin on a river, which that's exponentially gone up because I know the areas. But when I start investing in things I don't know about, that's where risk starts to come in. And I used to have over 100 real estate properties, and I used to have a hard money lending fund, and I used to have what else was I doing? Oil and gas. And I used to do, and it was so much. And now I'm simplified.
Yeah.
I've got cash value insurance. I've got 10 books. Each one of those books is like a piece of real estate. I've got 2 cabins on rivers that are right by each other. I've got this house, and I've got Bitcoin. And then I've got, my businesses, which I've got multiple businesses. And that's all that I need. Mm-hmm. I'm just going to grow the businesses instead of grow the complexity in my life. And so the formula is this: number one, make more money. Always seek to make more money by adding more value. Number 2, learn to keep more of the money you make. Can you save on tax, on interest, on non-performing investment fees, on improper design with insurance? That's going to be 10% or more of your income that you can start to keep. Then learn to grow your money. Use your investor DNA. What kind of investments make sense for you? Because risk is in the investor, not the investment. Yep. Real estate's good for some, bad for others, right? Private capital, good for some, bad for others. You just got to understand. And then the fourth thing is to always grow yourself. And Kyle, this is where I just think that you're an example. Dude, you've dove in. It's not even a word. You've dove into so many books. You've had conversations. You've gone to events, and now you're sharing it with everybody. I love that, because the alternative is the white coat investor. You know the white coat investor?
Oh yeah, I was just on their podcast earlier this week.
Yeah, and they're very different philosophy from me.
Yeah.
Now, I will say that he was pretty fair when he reviewed Killing Sacred Cows. He read it. I talk about life insurance. He's pretty much against life insurance. And he called me out on a few things that when I looked at the first version of the book, I kind of updated in the new version, saying, I could take that they were good points. But we were supposed to have a debate, and he backed out. So I was stoked about that. I was excited about it. It never happened.
Hey, I like him. I think he's smart for, maybe 80% of physicians out there, but it's very middle class mentality as opposed to thinking like the wealthy. So I almost compare.
If you're not going to take time, listen to him. Yep. If you're willing to make the investment of time, there's going to be other options.
Yep. I always compare it to the Dave Ramsey versus Kiyosaki. I think he's more the Dave Ramsey type.
That's very good explanation. I agree. Now, what's interesting about Kiyosaki is, he's really, I've been on his podcast a few times. We've been together and interviewed and stuff like that. He's definitely on the later years of his life where he's kind of like everything. He just is guns and land and bunkers. And so they asked me to write a book with him, and I said no. I was just probably 10 years too late. But Rich Dad Poor Dad changed my life, man. I read that book. I was like, wait, get assets that create cash flow. And I was like, that's great. And like, he's so smart to say, hey, when you have a loan on an asset, inflation helps you. Every single year, that feels like less and less. And as they destroy the dollar, it actually increases the asset value while it decreases the filling of the payment. So the government's actually, what they're doing with the Federal Reserve and even it's like it encourages someone who's intelligent to do that. Now, if someone's not going to invest the time to be a good investor, that's a very dangerous strategy. And so I think that Dave is good to a degree, but like, I'm like, when I look at Dave, I'm like, I want to learn what he does, not what he says.
Right.
He has like $600 million of revenue. Yeah. He has a big entrepreneurship academy, but he's giving advice that, to his credit, he says, sometimes my math doesn't add up, but I just go with probability of what the person will do. So what he says is, this is what I think people do. I'm just going to give this lowest common denominator. But I'm like, hey, if that's what you want to listen to, don't listen to me. Mm-hmm. If you want to take a new degree of responsibility, you want to have permission to prosper, you want to improve your cash flow, you want to be more intelligent around it. And the thing is, I'm not about encouraging risk. I actually believe that mitigation of risk is the key to wealth, not taking it. But it's actually risky for people when they don't know what they're doing. I'm like, be responsible to learn what you're doing. And so that's why I write so much. I write a lot, because as I learn something, I write about it. I want to let people know. And I had this thing when I was young. I was like, I'm just going to go into this business being more committed to what's right than who's right. And if I'm wrong, I'm going to own it.
Yep.
I'm going to say, you know what? This is what I thought, but this was the reality. And I got my butt kicked in 2008 and learned a lot. And I remember that in 2025. And some people forget, but I'm like, no. Like, I remember that,
I love it. We're going to get into all that because you are a genius in my mind. So let me introduce you real quick to the listeners.
Yeah.
Garrett Gunderson is a New York Times best-selling author of Killing Sacred Cows, What Would the Rockefellers Do?, Money Unmasked, Disturbing Sacred Cows, among others. He's got 10 books out there. He's the founder of Wealth Factory, a firm focused on helping high-income earners keep more of what they make without budgeting, deferring life, or following Wall Street's one-size-fits-all advice. And I believe you've sold Wealth Factory. Is that correct?
I did sell that in 2021.
Okay.
Yep.
Okay.
So started this program called Freedom Fast Track in 2006, bought a company in 2014, and then renamed Freedom Fast Track Wealth Factory because I brought on some partners. I'm still partnered with one of the people that was a partner there. I love him. He's great. And then after selling that, I decided, how would I rebuild in a way that's going to allow me to help more people without losing the connection to them? Because with Wealth Factory, we just got to a point where we had 2,200 clients, and it's like, I didn't know who any of them were. I'm speaking to a dark screen, and one partner's like, how do we scale more? And I'm like, you're going to hate me, but I kind of want to scale back and be more connected. And he's like, well, you're going to slow us down. I'm like, I'll go and buy me out. I'll go build something different, So that's how that happened.
Okay. So from mindset to cash flow, taxes to legacy, Garrett brings a refreshing and disruptive perspective to money. So to get started, as I mentioned before the podcast to you, I see you as one of the great modern financial philosophers. And you remind me, again, of Rich Dad, Poor Dad. You remind me of a modern day Robert Kiyosaki, not the current day Robert Kiyosaki, the modern day. I think you're a Robert Kiyosaki mixed with a Dan Sullivan, mixed with a Jim Rohn, mixed with a Tony Robbins, if you will.
Well, that's a high compliment. Like I've been coached by Dan Sullivan. I was in a strategic coach through my 20s, and I was even in the sessions that he taught. And I've been out to his place because I was one of his top 3 referrers for a long time. Nice. Read and listened to stuff from Jim Rohn way back in the day. He's got some of the most inspirational, succinct quotes you could have. I've seen Tony Robbins speak twice, and one of the best to ever do it, that's for sure. And I can't remember who else you said. So the people you said have had influence in my life, that's for sure.
Good. Yeah. I mean, you bring it all together and you simplify it for us. But again, you've had this disruptive, thinking, which is what Robert Kiyosaki did with Rich Dad, Poor Dad.
Yeah.
It disrupts the traditional way of thinking. And I think, for us physicians, we need that because we don't learn this stuff. So What really started all this for you? I know you're an entrepreneur at heart. You've been an entrepreneur since you were a kid. You wrote
Yeah.
your first book at 22. Is that correct? Killing Sacred Cows?
I started to write it at that age, and it was a train wreck for the first 2 years. So it was a terrible name of a book. The working name is embarrassing. It was called The Strongest String, because remember when the stories of them tying elephants to chains, and then eventually they would replace the chains with string, but they wouldn't break free.
Mm-hmm.
And so that's what I saw like myths doing. So I it sounded like a tampon book, but it was that was the working title. And I only had written 72 pages in 2 years because I was really insecure as a writer. And I had these ideas of what the myths were, but it didn't release official. Well, the self-published version came out April of 2007.
Okay.
And then I got picked up by a publisher and re-released it as a really radically different book, August of 2008, which was perfect timing for the message because everybody was willing to listen. And I think that's part of why it hit New York Times. This is like the storm that was happening. And so that was my first book, and I just rewrote it. There's now Killing Sacred Cows 2.0. It's shorter because I became a better writer, made it more about the reader, and I added investor DNA. So I think it's twice as good and, only 2/3 as long, which is good because we all have a lot going on, and I would rather it be read than, and the first book is funny because people would be like, this chapter could have been skipped. And I was like, that chapter could have been skipped. It's pretty redundant. Like as much as it like hurt my ego,
Mm-hmm.
I was a kid when I wrote it. And when I reread it, I'm like, dude, how did I know? It's like, it's kind of amazing that I knew it.
Mm-hmm.
It's like, I feel like it was gifted to me. Sure, I did the work, but like to be able to have that flow through. And again, went back to the philosophy of what's right, not who's right. That's why I was able to learn so early at an early age, and because of a few mistakes and questioning everything and being annoyingly curious to some, but got to the other side. Like one of my mentors called me a genius a few years ago. Since you said genius, is like, I don't know if it's because I did comedy and he had tried it once and didn't do well. But he's now a licensee of my programs.
Okay.
So how cool is that? It's pretty special.
That's amazing. Yeah. And I want to get into all this. I mean, mindset is a big thing that you talk about. And one thing I do love what you say is money without the mindset creates the high risk. Is that right?
Yeah. So imagine this. Let's say that someone came to you 10 years ago and said, you need to put this money in Bitcoin. And you're like, I don't know what Bitcoin is, but I'll give you some money. And then that Bitcoin, you one day remember you have it and you look and it's at $104,000. And you're like, whoa, wait, I made multi millions on this deal. So now you've got this growth, but you don't know why. So what happens is when we have money that grows and we don't know why, we typically destroy that growth either by selling too early, by spending it too easily, by taking other risks because we feel intelligent even though it might have been luck. And so if we grow our money without growing ourselves, that gap between our growth is risk. So it's like going to the gym. If I don't have the strength and I put too much weight on it, it's collapsing. But if I work up to it and build it over time, we got to build that financial strength and that financial intelligence. And we have a permanent life penalty if we don't have financial intelligence. If we go, I just don't have time, I just don't understand, you pay the price every day you're alive with overpaying tax, overpaying on insurance, having losses in the market, putting money in bad places, like just all of that kind of stuff.
Love that. And it takes time, right, to build that mindset. It's just like the muscles. It takes time to do it. You got to read the books. You got to put in the effort. You can't get a six-pack overnight, just like you can't get financial intelligence overnight.
And it's interesting because, look, I've been through a lot in my health journey over my life. But basically last April, so I just hired this guy and he designed my macros. I hired this woman that designed the food that would be very best for me to eat, that would give the most concentration of nutrition within those. It was a set plan. I have one sitting here. And I just ate exactly what was on the plan. And then I did the workouts that I was told to do. And I got so strong and lean. And in the past, I would always work out even harder. I was doing CrossFit, but I wasn't as lean. Mm-hmm. The formula was there. The framework was there. The model was there. And it like took away the guesswork. What it meant was like, in the past, I might have a really busy day. I might get like in a flow of writing. And then I'm like, crap, I haven't eaten for 5 hours. Yep. And then I would be so hungry that I would just scrounge around and see what we have. And if it wasn't healthy, I might start snacking on it. Yep. Now it's like, I know exactly what I'm eating when I'm eating it, and there's no guesswork, and the results are there. I think in finance, when we don't know what's going on and then we scramble, we make mistakes. We get into junk type of investments versus good investments because we feel we're behind, or we feel like someone else did well, or we're listening to some story and there's no model. And if you don't have a premise or philosophy, someone else will sell you theirs. And it might not be in your best interest. That's the thing. So you've got to get clear about what your financial fitness looks like, which is having your financial house in order, how you create financial independence, which is having cash flow from assets to cover your expenses, and financial freedom, which is that mindset. Like, it's a bad investment for me if I invest in it and it sabotages my sleep. If I'm worried about it, if I'm stressed, if my cortisol levels go up, it's not the right investment for me. It might even make money, but I'm the asset that matters the most. And if that destroys me, it's not worth the return, because then I'm missing out on moments of life. I'm not thinking creatively. I'm embracing scarcity versus abundance. And so, like, all of these things really, really matter.
Love it. So a couple things, because my next question, I want to get into abundance versus scarcity, because even as physicians, I think most of us have a scarcity mindset. But when you were talking about your diet, your workout plan, being fit, I think efficiency and intention were the two things that came to mind with that.
So
you're the great philosopher, man. I love this stuff.
Let me make something that's so relevant, and it's a little controversial, that will really set this home. AI. There's so much scarcity around AI. It will replace jobs. It will destroy us. That's one of the narratives. Well, part of the reason people feel that is they believe in a finite pie. They believe there's only this much to go around, and if AI takes work that humans were doing and does it more effectively, there's less left over. Let's go back to the 15th century with Gutenberg. The printing press comes out. The same stories were happening. There was like, hey, this is going to destroy humanity. Clergy was like, this is going to be bad, and it's evil. And you had businesses saying, no, like the scribes are going to be out of business. And guess what happened? An explosion of prosperity, because value is not a finite gain. We can actually expand our value. And if we have tools that help us to be more efficient and effective, what I find is people aren't necessarily going to work less like you and I. We're going to become more productive. So we're going to be able to produce more value. And if we go back hundreds of years, think about the lifestyle back then was so much less than it is today. The quality of life was drastically less because ideas hadn't been invented. Technologies hadn't been, brought to our attention. And so it was more effort. There were more people as a percentage of the population starving or in fear of hunger back then. It was like 59% 300 years ago. And today it's like 17%, right? Like, so it's radically different simply because it's not a finite pie. Exchange creates wealth. And the more exchange that we create, there's a byproduct of value for everyone, because there's certain things that we used to pay for that are free now. And there's going to be things in the future that we're paying for today that are going to be free. Now, if we just hold on to the past and go, well, I got to hold on to what I got. I got to take what I can. You can't do it. Like, let's resist it. Let's create regulation. Then what happens is we don't create an exciting, compelling future. And so I think that that's what we're on the same precipice of. And it's a crazy time because it's more important than discovering fire. It's more important than discovering the will. It's so important and instrumental. And if we fear it, the best way to not fear it is try it, is learn from it, is to utilize it. Will there be disruption? Oh, hell yeah, there's going to be some disruption. Will there be times of massive discomfort? You know it. But the thing is, it's going to be a much more effective place if you just learn to embrace it and utilize it. And that's scarcity versus abundance, because scarcity says there's only so much to go around. Profit is evidence of deception and coercion. Fear, doubt, and worry is the mantra, and scarcity is the greatest destroyer of wealth. Where abundance would say, even if there's a finite amount of resources, there's innovation and ingenuity. There's a different combination of how we get there. And it's funny because Thomas Malthus, he was a philosopher, but basically a communistic type of thinker. And he said in the 1700s, we're not going to have enough food because of this rising population. And the first thing I thought, he talked about buffalo specifically. I'm like, does he not know that they can, reproduce? Like, is this like, did he not take class where they're like, hey, by the way, they can have sex and then there's babies? We can abuse that though, right? Because there is a counterfeit to abundance called ignorance and called lack of stewardship. And it's like where we overdo, where we get caught up in greed and then we destroy instead of produce, or try to, but I believe in abundance. Profit is evidence of value creation, that it's innovation and ingenuity, not fear, doubt, and worry. That there's alternatives, there's different ways. And if we're responsible and sustainable, and that's part of our DNA because we care about someone outside of ourselves, then we can have a much better place for all of us. But if we think, hey, I grew up with coal miners, right? My dad, my grandparents. If they're like, no, we can't get rid of coal mines because that's our job. And if coal isn't clean energy and there's 10 other alternatives and they do all they can to prevent those, that's scarcity. And that happens because some people they're just so worried about putting food on the table, they can't see the future. And so what I have to do in myself is be like, what is it that I'm stuck in my ways that's principled? And where am I stuck in my ways that's actually scarcity or that's actually a lack of innovation? And then that helps me to be curious and to drive forward.
Yep. Yeah. I mean, sticking with that abundance versus scarcity, because again, I just mentioned that so many physicians still live that scarcity mindset, even though we make good money, we're bringing in good money, but we're taxed and interest and, basically your lifestyle creeps up.
Holy shit. Yeah. Cause they expect you to have a good lifestyle.
Right. Exactly. Yeah. So
right?
and
they expect you to have money. So you have litigation potential. Right. And you have also this phenomena that says, I worked my butt off for this. I went into debt. I did all this extra schooling. I deserve this. And the problem is that's where lifestyle creep comes in. Yep. And, I have an advantage as an entrepreneur that I started making money at 15 and I could start working on cash flow where you were in organic chemistry. Right. Yep. Because all my friends that did organic chemistry, that's harder than anything I've done in business. Sure. So, it's just how it is. And so you kind of have this disadvantage and it's like, how much longer do you have to put off your life because of, schooling and debt? So I get that phenomenon of what it does in the mind. But if you can say, look, who cares what people think I should have or do? What would it take to be financially independent? What would it take to create cash flow that if I'm not in surgery, I still have money coming in? Yep. And then surgery's a get to, not a have to. It's an option, not I got to get it done to pay the bills.
Love that. Yeah. You don't want to be a slave to your job, which I think a lot of physicians are feeling that now. And so we'll get more into this because I want to get into your books as well. And you're going to talk a lot more about that. But before we dive into your books, something that you just touched on that I love, because I talk about real estate investing and anything investing, which there's pros and cons to it all. So you talk a lot about investor DNA, which is awesome. It's a great way to put it. How can high income earners like physicians begin identifying their investor DNA to make aligned decisions instead of chasing what's trending or what they see on, whatever the hype is out there? How do we inform ourselves on that?
Like 50% of the people I worked with over the last decade were like, doctors of some sort, whether it was surgeons, oral surgeons, whether it was plastic surgeons or dentists or chiropractors. It's like, for whatever reason, that was the market that we started to work with. And so I had a lot of people in that health world. And one in particular that I was working with, they were investing in a lot of stuff. And I said, hey, he's actually got one of the biggest podcasts out there and he's really smart on the biohacking side. I'm like, why are you investing in these things that have nothing to do with health? You know about the people that run companies, about the things that are going on with those companies. Like, what if you stuck more towards that? And then he ended up investing in a small amount in a company that was in, cannabis around like pain management in Canada and made millions on it. And it's like, he understood, he knew the people that were working on the laws. He knew all that where the average person doesn't have access to it. So I was like, dude, you invest in all these startups you know nothing about because of your friends' companies. Like, stop it and only invest in what you know. Yep. Now, for some people, I've had a lot of doctors that they buy the office that they actually work in, right? So they'll buy I have a friend out there that's built surgical centers in Indianapolis, and he'll partner with them. And it's like, okay, that's one option, but real estate's not for everybody. Right. And you also have to think about the time and effort that it takes to do that. Other people might be really good at what they do. And like, you're going, hey, I see a problem in my profession. I want to improve the profession. So now you're in the intellectual property game. So that's an investment for you now that you're in the intellectual property game, because you have past episodes. And if you end up, doing books or stuff like that, you have this other asset. But the big three are their business. So it might be about hiring other doctors and other, adding additional services or partnering with other people. It's real estate or it's intellectual property. Those are the big three cash flow generators that create recurring revenue. If someone's like, well, I'm just too busy for all that, then you're just going to get lower returns or you're going to take massive risk.
Yep.
Because if you're just going to give your money to a bank, they're not going to pay you a high interest because they have to earn more than what they're paying you. If you're giving your money to a fund, like a mutual fund, the difference between the top 20% and the bottom 20% is only 2% per year. And index funds typically beat everything out after 20 years anyway.
Mm-hmm.
So again, it's not a cash flow investment. So if the first thing I would look at is if you're not willing to like really dive in, you might just say, well, which loan should I pay off to improve my cash flow first? That's kind of like, I surrender. I'm just going to do the easiest thing,
Yep.
Then from there, like for me, I was like, well, I built a community where I teach and people pay monthly. I finally decided after making so many people so much money on insurance, because I wrote a book, Rockefeller, that sells a lot of insurance. I'm like, I'm going to start an insurance agency because that creates recurring revenue. And, I'm already doing the teaching. I might as well, and it doesn't change what the client gets on return. It's, it gets paid out to someone.
Exactly.
So that's recurring revenue. Or when I have my books, I've got royalties on those books that keep coming in, So like I look for recurring revenue type of businesses and I invest in those types of businesses that I have a degree of ownership in or a degree of control. And I'm building a media company where I'm just putting more content out there. And then I've got my first deal where I'm a brand ambassador for someone because they built an AI platform to help people with their finances. So they're taking my content and using AI to make it effective. And now I get a third of the revenue because equity for attention. So I'm just giving people ideas.
Yep.
Like we're so closed in finance to just be sold this box of here's what you're supposed to do.
Yep.
You put money in a qualified plan, like a defined benefit or a 401k or a solo 401k or a SEP IRA. And then you wait for 30 years and then you're going to be in a lower tax bracket. I was like, you better hope you're not, because it means you have less money and, things get more expensive, not cheaper. So that's hopefully at least a little bit of a landscape of where you might invest.
I love it, man. All right, let's get into your books. You talk about, another thing you talk about is soul purpose, which I love, SOUL, soul purpose. And that is like basically the whole aspect of where all this comes together, right? I mean, it's kind of the overview of it all is soul purpose. And you wrote Killing Sacred Cows, as you mentioned, was your first one. And and I want to talk, and then Disrupting Sacred Cows is the 2.0, correct?
Well, no, so there's Killing Sacred Cows. Disrupting Sacred Cows is a sequel, and Killing Sacred Cows 2.0 is a rewrite of Killing Sacred Cows.
Okay.
So it's really two books, even though there's three. If you look behind me here, I have all my different books, and some of them are like, there's 4 versions, right? There's the first version and then a second edition. So I just kind of,
Yep. Okay. That's right. And then one of my favorites is What Would the Rockefellers Do? I think that is like mind changing when it comes to that. So just on Killing Sacred Cows, let's just start there. 1 and 2.0. A lot of physicians think that, money is power. High risk equals high return. Accumulation. This is what we do. And I'll tell a quick story. My dad, who passed in December, and he had built a business and sold it multiple times and did very well. But just believed in accumulation over time, live off that when you retire, and then, pass it down. Didn't have a whole lot to pass down when he passed, unfortunately, because he didn't know about all this other stuff. So accumulation is wealth is kind of what we all go through. And I'd love for you to kind of go through those, not one by one necessarily, but just, why are those myths?
I'll pick the big three. We've covered one of the big three.
That'd be awesome.
So one is the finite pie, which is people believe there's only so much to go around. But every time, if I bought something from you today, or if you bought my book today, you could go, hey, I got more value than the $20 because that's why you have me on. I could say, hey, that book was worth less than $20 because I have plenty of them and I wrote it. So we both end up wealthier. You get a book that you thought was worth more than 20. I get 20 and I thought the book was worth less. So here's the deal. We all get wealthier through unequal exchange.
Yep.
Like when you operate on someone, like you could do that effectively and efficiently. If I was like, I want to save money on an operation, I'd have to go to school. There's no way to save money. It's like, there's just no efficiency, right? And for surgery, I'm like, dude, I was worth way more because now I'm better off, right? Than if I didn't do it. So unequal exchange creates wealth. And That's really important. Here's the thing. One of the issues that really destroys exchange is a notion of self-insurance. There's a lot of people that think, you know what, I want to build up enough assets that I don't have to have insurance. So let's just say that you don't have a mortgage. You don't have to carry homeowners insurance if you don't have a mortgage.
Mm-hmm.
But if that's $1 million home, just use easy numbers, you've got to have $1 million somewhere in case something happens. And that $1 million can't be locked up. Otherwise, it's probably going to infringe upon peace of mind. So you save $2,000 on homeowners insurance, but you lose a lot more than $2,000 locking $1 million up. Like maybe you can get 10% on $1 million. That's $100,000. What if it has to sit in a savings account right now and it's at 5%? That's a $50,000 cost to save $2,000,
Mm-hmm.
right? That's the issue with self-insurance is if we don't insure, we pay at least $1 for $1 of coverage because there's no such thing as self-insurance. It's no insurance.
Right.
Not insured means my cash becomes insurance. If I effectively know how to design insurance, I'm going to pay pennies on the dollar, freeing up my cash. So now I can take that $1 million and do something with it. That's a really important chapter because it would say the cheapest way to have coverage is to buy the most of the best that you can.
Mm-hmm.
And only insure catastrophic things, not inconsequential things. When does it make sense not to have insurance? I have a $2,500 deductible on my home. If there's a less than $2,500 issue here, my father-in-law knows what to do.
Yeah.
My kids and me might get on YouTube. We have a handyman. We'll take care of it. If I make a claim, they're just going to raise my rates anyway.
Right.
So I want that more for the catastrophic. So when we think about catastrophic versus inconsequential, we pay cash for inconsequential and we transfer the risk of catastrophic.
Mm-hmm.
You actually will save money on insurance and don't self-insure because here's another example. I have life insurance that's going to be around one day longer than me. It's a death benefit
Mm-hmm.
that comes in. It's permanent. It's properly structured, optimally funded, whole life insurance. And if I die, it comes in, which means I've just bought future net worth. Now, I don't want to die to benefit from it, but it's future net worth, which means I can focus on cash flow. Because to get to that net worth, it takes risk and time and tax and, all this. But I just secured it day one.
Mm-hmm.
Because I know it's there. I've got so many options, and this is what we talk about in Rockefellers. And if people just DM me on Instagram,
Yep.
Garrett B. Gunderson. I don't know if surgeons have Instagram, but
They do.
I'm trying to be younger than I am. Garrett B. Gunderson. And you just go ahead and put in Kyle. You just put in Kyle, and we know when it comes from Kyle, you get a free copy of the audiobook of
Nice.
Killing Sacred, I'll give you Killing Sacred Cows, and I'll give you what the Rockefellers do because I'm combining both philosophies here. When I know I have that death benefit, I can make other assets perform 20 or 30% better in cash flow in the future. For example, most people are taught never take money more than interest and just live off your interest. Well, that means that they never get to spend or enjoy that money. Now, let's just say in the future, I said, why don't you start taking some principal out and interest so that let's boost what you're taking 30% a year. Now, at 90, your account's going to be at 0. But we have this death benefit here. If you're still alive and kicking, guess what we can do? I can go to the bank and say, we got this death benefit. We want to take a reverse mortgage. Can we just get a home equity line of credit that there's no payment on? And the death benefit will be collateral. It'll pay the bank off if the kids want the home. If it don't, they can just take the cash. So now we took a dead asset. We got all this tax-free money out of it, and we spent more of our cash, and we have access because the death benefit existed. Now, for some people, they might be like, what the hell is this guy talking about, right? It's like financial version of OCHEM. But ultimately, you can just listen and read about it because what it's going to do, again, is take a small asset and have it perform like it's a bigger asset. They might have two people with $1 million net worth, but if one person's getting $60,000 of cash flow from it, the other person's getting $120,000 of cash flow, the wealthier one in my argument is the one with the higher cash flow. And so we're trained and indoctrinated to be in this accumulation game of net worth, but cash flow is the real game. And so if I can unlock assets to provide more cash flow or create contingency plans or show you ways you could spend a death benefit while you're alive, man, it's like we now have improved your life without additional risk.
That's powerful. Very powerful. And people need to rewind that and listen to that multiple times. And I just got off the phone right before talking to you with Scott Jared, your buddy, and we went through that exact same thing with mine personally. So I love all that stuff.
When I heard his voice, I was like, dude, that sounds like Scott Jared. I was like, That's crazy.
Well, heck yeah. You guys were good luck charms for the Pacers. Maybe not the night you went, but last night. At least.
Yeah, man, they played an amazing game until the last 4 minutes. They just ran out of legs, but that was cool that they won last night. I was driving, so I just watched the highlights when I got home.
Nice. You might be a Jazz fan.
I mean, I am. I had season tickets before. It's hard to be like a diehard fan when they're dying. Sure. I mean, I am a little fair weather fan because I want to have fun. I know that there's some people that go rain or shine and they go, right. Bad season, good season. I didn't go this last year. I went the year before to a game, and when I went, Darren Mitchell was playing and Carlos Boozer. We had season tickets, and I had season tickets during a Karl Malone and John Stockton year with my partners, and so it was like those were fun. But yeah, I'm kind of a fair weather fan right now. I guess I was a Pacers fan when I was in Indiana.
There you
I'm
go.
like, hey, I'm in the booth next to all these old Pacer players. Yeah. I love this story that they're pulling this off, and nobody ever thought they could do it. Like, it's just fun to have an underdog story. It's like, Absolutely. It's cool. And just the energy in there. And it was like, my wife loved the stadium. She's like, this place is so cool.
That's amazing. I mean, Indiana's a basketball state, right? We had Hoosiers and, we have really good high school basketball. The Pacers just haven't been good in years. So it's nice to bring that back. All right, on to the next book. And you said, if people DM you, Kyle, they'll get What Would Rockefellers Do and Killing Sacred Cows, which
audiobooks of both. Yeah.
Amazing. I love it. All right. What would Rockefellers do? This is powerful. I'm reading it for the third time now. And I wrote down, I got my family constitution. We have all that. I have a 4-year-old.
That's amazing, dude.
Yeah.
Nice.
Oh yeah. Once I read it the first time, man, I was like, I'm all in on this. So, love what you're doing with that. Do you mind? So you just talked a little bit about life insurance and the benefits of it. People get turned away when you talk about whole life insurance, right? You mentioned White Coat Investor. He's all about, buy term, invest the rest. Dave Ramsey talks about the same thing. Why is term not the way to go? Why is the cash value whole life insurance the way to go? Let's just start from the beginning, if you don't mind.
Term has its place. Term has its place for sure. Like, when you're in your residency, get some term insurance. You don't have you don't have big, strong cash flows. And what I want to do is make sure people have the right amount of death benefit. You want convertible term so that when you have a better cash flow, you can convert that. And so that's good. What I don't like is when I see people have a small amount of whole life and no coverage above it. And so they're exposed. Yeah, they've got this cash value, but if something happened to them tomorrow, their family's in real trouble.
Yeah.
So I want to make sure coverage first, right? Economic replacement. Like, what would be the economic cost if your family lost you? Make sure you have a lump sum of money that would replace that cash flow. That's the philosophy first. Then here's my issue with term and invested difference, whether it's with Dave or White Coat. All right, let's say that you're a successful guy, Kyle, right? You plan on being more or less successful in the future?
More.
Okay, so with that plan, imagine someone comes to you and they go, you should buy term invested difference because you could earn really high rates of return in the market or other investments, and that's going to outperform the cash value of whole life. And they're right on. Cash value is probably not going to outperform the stock market. Mm-hmm. I mean, volatility and taxes, there might be some comparison, but it's the different thing.
Yep.
When I think of cash value, I think of it as your asset allocation for your fixed income. Fixed income are like bonds and money markets and CDs. Mm-hmm. In the short term, cash value is going to underperform those assets, but in any 30-year period of time, cash value from one of the top 7 mutual companies has outperformed all fixed income assets, because once you get past the cost of insurance and it gets more efficient, like it just does. So it's like, now you don't have to pay for term insurance. You have to pay tax on the gains. So it becomes even more attractive. But here's the issue. If someone convinced you term and invested difference, we fast forward 30 years, you've crushed it. You're worth tens of millions of dollars, maybe hundreds of millions of dollars, whatever it is. You're going to have an attorney come to you and say, Kyle, we have a problem. You're going to owe so much in tax when you die, and more than half of it's going to go to the government. Mm-hmm. Let's buy some whole life. Okay, now we're going to go buy it. Like, imagine this. Like, if you get a 100-year mortgage, your payment's pretty low. If you get a 30-year mortgage, it's higher than a 100-year. If you get a 15, it's higher than a 30-year. If you get a 5-year, it's way higher than a 15-year, right? Yep. Because and that's what happens with insurance. If you're buying insurance when you're 75, they're going, hey, it's like a short mortgage. You have a much higher payment because you're going to die sooner than someone that's young. So you could have just got the death benefit to come along for the ride rather than put money in money markets and savings accounts and CDs and bonds. And now you have to go come up with the money when you're older and might not be in the same health you're in today. So that's what's like, I know I'm like passionate about this, but I'm like, what? So they didn't plan for you to succeed? Like, I don't understand. Why would that be? That's crazy. And that's unfortunate. What they do is because someone like Dave only thinks about expense and he doesn't see it as a investment. And I'm not saying cash value is an investment. I'm saying it's more of a savings. But if your whole viewpoint is how do we reduce expenses, and then we only think about expense today, one of the ways you could reduce your expenses is drive a broken down car. But over time, the amount of time it takes you in to repair the car, the extra gas that you pay for it, the frustration, like eventually it becomes so expensive. But they're like, no, but it would be so much less now. Yeah, but eventually, if you buy term insurance and you hold it till you are supposed to die, life expectancy, you'll pay more in premium than there is for death benefit. Because they keep it level and then they exponentially increase it when there's a chance of death. Only 1.1% of the policies ever pay out. So why would I want to put money into something that only pays out 1.1% of the time if I could have something that would pay out 100% of the time because I'm guaranteed to die? And even if we figure out how to live longer than we live now, there's policies that pay out no matter what at age 100 or is no later than 120. So you're like, cool, I'm going to have that come in no matter what. Why not take advantage of that?
And before we get into the real Rockefeller method, why 401k I think is on that same level, right? A lot of physicians, a lot of middle class people are dead set on the 401k, and that's their saving grace, unfortunately. But tell us why even using this cash value whole life insurance can be better than the 401k. I guess 401k is more of an investment, but why is a 401k a bad thing in your mind?
All right, I'll list it off quick. The government's your partner. Who wants to partner with the government? What they say is, we'll let you pay no tax today, and we'll determine how much you pay in the future based upon your and our circumstance, but primarily ours. So if we're in trouble, which we just let you know, we have $37 trillion of debt, that tax code, we can change what we charge you. That's my first issue. You're partnering with the government and they're tax addicts. So like you could be deferring into a much higher rate. When an advisor says, well, you'll be in a lower tax bracket. How? Inflation alone, when you're retirement age, inflation is going to make it where you have to have way more money to live even close to the same lifestyle. So that's just a faulty notion that people say is you'll be in a lower tax bracket. To be in a lower tax bracket, you have to have more write-offs. In retirement, that typically doesn't happen. I mean, De Niro's still having kids. Mick Jagger's still having kids, but usually, people have their kids out of their house and not a tax write-off anymore when they get that age. The second thing is, if you own a business and that business is gone, that was your biggest tax write-off that you possibly could have. And so that could put you in a higher tax bracket. Or the government could raise taxes. I mean, from 1913 till today, the lowest tax rate was like right when it came out, and it was going to be temporary. It was going to be 7%. You had to earn quite a bit of money to get hit with it. The top tax rate got up to 94% for the top marginal rate. And from 1944 to 1981, the top tax bracket was above 50%. So we have a huge history of being above 50%. And right now we're at 37.5. What if that goes back up at the time you retire? So that's another issue. No cash flow. Penalty if you want to get to it early. More fees. There's not just the fees of whatever the investment is. There's now the fees of the vehicle where the investment's held inside of the 401k. So that's just a few. I mean, in Sacred Cows, I cover the 15 problems with it. I don't have a 401k. I had one when I was young. I cashed it out, took the penalty, and was like, I'm going to invest in things I know. I had a client that had $1 million 401k. There were $70 million, and they were losing money in 2008 in their 401k, and they were super stressed and pissed off. And I was like, you don't have to have a 401k. They're like, well, of course I do. Everyone has a 401k. I'm like, yeah, you actually don't have to have one. Like, what are you really good at? They were good at art. They were good at property, and they're good at business. And so I said, do you ever sell any art early because of a cash crunch? He goes, yeah, we sold a Warhol. I'm like, you could have just used your 401k to pay for that cash flow crunch. He goes, but there's a penalty. I'm like, here's my view on a penalty. Kyle, if today you wanted to get a loan and you could go get a loan anywhere, okay, we'll say you could go get a loan anywhere, or I'll give you a loan And the terms of my loan are, I charge you 10% year one, 0% for the life of the loan. Which loan do you want? Any other loan you can get in the world, or this loan that I'm giving you?
Yeah, I would take the 10% and 0 after that.
Well, there's your penalty.
Yep.
Go ahead and take the 10% hit.
Yep.
It's opportunity cost. So that's, that's a lot of my issues with 401k. And by the way, he did end up getting rid of his 401k. He bought into a coffee company that he's 40% owner of, and it just got valuated for $77 million. Wow. So his 401k from 2008 till today cannot compete with, that $1 million. Mm-hmm. What it would be today at best, best case scenario. Rule of 72 would be that if it earned 10% a year, it would double every 7.5 years, yep. Right? It's been, basically 17 years. So let's just say that it doubled to 2 million. It doubled again to 4 million. It doubled again to 8 million. So 8 million would be the best case scenario. Big return, not having the down years. And now he's got 40% of 77 million. So he's got almost 4 times more than the best case scenario would have been. And it's just because I gave him permission to prosper.
And I've heard Ted Benna, the founder of the 401, creator of the 401k, said himself, right? He talked about how it was supposed to be just a supplemental retirement plan, not your entire 401k should be a retirement plan. And he wrote in a book, the foreword for the book 501k plan, which talks about life insurance. I think, unfortunately, he talks about IULs a little bit too much, but
he probably just doesn't understand all the problems with an IUL.
Right. Yep.
Yeah.
But okay, so keeping to that theme, what would the Rockefellers do? Again, one of the best books out there. I'm telling people, read Rich Dad Poor Dad and read this book among your other ones. But let's talk about legacy. Let's talk about how you can use your cash value whole life insurance to grow, protect, and perpetuate wealth. Pass it on to your heirs.
Yeah, you could buy insurance on yourself, on your spouse, on your kids, on their kids, and then every time someone dies, it replenishes the trust. So you set up a trust with parameters to protect the assets, to have description of what to do. You have the beneficiary of all the insurance be the trust, and then the Rockefellers did that. They're almost into their 7th generation. So it just, maybe taxes are high one year. The death benefit comes in tax-free to replenish. Maybe inflation starts to erode the trust. Someone dies, it helps replenish it, So it's so simple, but it's nice that a lot of people are doing it now because the book's really out there. I mean, a lot of people know about it. It's I think it's brought a really positive light to a de-risked asset. You have an insurance company that's giving you a guaranteed contract, and there's backup for that in each state. And, FDIC has been tapped into a lot, even during my lifetime. Mm-hmm. In Utah, the Guarantee Life Association has never been tapped into for a single dollar. So think about that, so much more stable. Yep. It's really kind of the last bastion of a de-risked asset. So I'm highly, And
a lot of these mutual companies, insurance companies you're talking about, have been paying dividends for over 120 plus years, right?
Yeah, we've got 180 year company. There's one with over $1 trillion in assets now. So pretty big. There's really 7 companies that I would own a policy with out there. There's not a lot. They have to be, all A ratings. They could be A- in some ways. They've got to be worth hundreds of billions of dollars. They've got to be over 100 years old. They always have had to pay a dividend. They have to be a mutual company, not a stock company. So they don't share the profits with shareholders. They just share it with policyholders. There's a certain criteria, and there's companies that meet that criteria. And I think I have policies with 5 different or 6 different companies now.
Okay. Yep. So read the book, everybody. It's one of the best. We're going to start winding down here, but a couple more points I want to bring up because I just watched your comedy special, American Ream.
Nice.
Fantastic, man. You did a hell of a job.
Thank you.
And your sons were in the audience, which cracks me up.
Yeah, fun. Super fun.
And one of your, I think your younger son introduced you on stage, which is really cool.
The night he actually did 5 minutes of comedy.
Did he?
We just have pull the introduction, but
okay,
he did 5 minutes and he brought the energy of that crowd alive, and it was so good. It was great. He made fun of me a lot. He made fun of my gray hair. He made fun of I don't know, a couple things. It was good.
Well, what's your nickname? Is it Financial Jesus or Money Jesus?
So I've never called myself Money Jesus, but I get called that a lot of times at events because one of my buddies, I called him a nerd, and so he started calling me GQ Jesus. I'm like, dude, GQ Jesus, I'll take it. And then it kind of some people started saying it, especially when I started doing comedy, I would joke about what I look like, and then I just started having people say I was Money Jesus when I come to events. I went to this event I was going to speak, and this guy Brian was like, "It's Money Jesus," and then the person introduced, and then that event I booked like 7 other speaking events. So everybody's like, "Oh, we got Money Jesus coming," and it just kind of took. So we just launched a YouTube channel called The Money Jesus.
Nice.
We're going to just start putting up fun videos around money topics that a lot more entertainment than education, but a little bit of both.
That's great.
Yeah.
Hey, so part of what I do, I call my company Legacy RX, and I have a conference coming up in
Right.
October, my first one, and I really want to talk to people about legacy, more than just money. And
Yeah.
so I really want to ask you, your books go into that for sure, but what does true legacy mean to you beyond net worth, beyond financial?
Legacy is weaving philosophies and love throughout the people that I touch. So it's not just my family, it's also other people, because my books are part of that legacy.
Mm-hmm.
The experience I create in my life is part of that legacy. The rituals and retreats I have with my family are part of that legacy. The family crest that we have over our mantle, part of that legacy. So it's how we live, it's how we influence, it's how we learn. And so I want to leave a legacy, but I want to live it along the way. And so we have rituals that reinforce our belief systems. We have traditions that get us together where we have deeper conversations and have fun at the same time. And then we really have like these symbols that will last beyond me being here. And so that kind of helps that it could improve and help someone's life, so I don't have to make all the same mistakes again. And so every time I write a blog, I'm like, this is legacy. Every time I write a book, I'm like, this is legacy, because my son's reading a book, or when I put up a video, I'm like, these are ways that my posterity get to know the very philosophies that we're living. And, I gave a speech for an hour and a half yesterday, and my son was in the crowd and he was taking notes. And I was like, I'll be honest, I was thinking about 15 minutes of it was really me wanting to give him a message that it might be hard for him to hear one-on-one. And so it was really kind of special that I could do that. And that's legacy.
Mm-hmm.
We're creating these quarterly retreats with our family that will drive or fly somewhere. We'll either drive if it's close and get time together in the car and we have good conversations, or we'll fly and we'll keep them relatively close and just spend a weekend so that we can have conversations, we can have some fun, and we kind of mix and mingle that.
Mm-hmm.
So yeah, legacy's it gets to be whatever you want it to. Like, everybody gets to define it, but to me, it's like, hey, it's that the people that I love most get to know and experience me in a way they feel loved, seen, and heard, and inspired to live their best life.
That's amazing. Wow. Yeah. Any physician listening to this, I talk to young physicians all the time who are like, my ultimate goal is to leave a legacy to my kids, my grandkids, this, that, and the other, but they don't know how to do it. They don't know the process. So last piece of advice, if you don't mind, how would you educate a young physician or even, anybody that is going to do well financially? How would you educate them on, next steps or something that they can start to strive towards?
Just get the foundational pieces, like, really think about what you want in life and write the script. I love the Legacy RX, so I'm going to say write the script. Be intentional about how to design your life. What are your boundaries? What are you going to do? What are you not going to do? What do you have interest in that you are willing to learn about? And what do you have competencies that you're willing to deploy that capital towards it? And just be patient enough to design before you get destroyed. Get intentional about it before you get in risk, and be willing to say no so that you can say yes to the right things, and reserve the yeses for the greatest hell yeses instead of the, well, this is an opportunity, but it was actually a distraction. It just was disguised,
Yep. That is awesome.
Well,
all right.
Thanks for having me on, man.
Hey,
that
absolutely. Hey, last 4 questions, just real quick. They're quick ones. Because you're an author, what book are you reading right now?
I'm rereading The Creative Act for like the 3rd time. Rick Rubin. It's
okay.
Next level.
All right. The Creative Act. What advice would you give to your 25-year-old self?
Better contracts in partnerships, and stand for your value, and don't people please. Like, just know your value, stand for it, be kind, be generous, but don't allow people to take advantage.
Awesome. What is your definition of wealth?
The ability to be present.
Love it. Proverbs 11:25 states, "A generous person will prosper. Whoever refreshes others will be refreshed." If you could make a big impact by giving back, what would you or have you focused on?
It's amazing. Like yesterday, I spoke at Governor's Honors Academy, which was the thing that gave to me, and I've been donating a percentage of my revenues in the past to that, and a percentage of my revenues to an entrepreneurship program that I was able to go to when I was a teenager that changed my life. And, even writing the kids' book was part of that. It wasn't a big moneymaker. It's like, hey, I just like to invest in people that way. And it's like, so to me, it's how do I help inspire an entrepreneurial spirit by not just putting money towards something, but giving them my time.
Mm-hmm. That's great, man. Garrett, thank you so much for coming on. Thanks for sharing your time and your wisdom. Our audience will be better because of it. Where can they follow your work, read your books, or watch The American Ream?
Yeah, The American Ream on Amazon Prime. That's Amazon Prime. And then Garrett B. Gunderson on Instagram, daily doses and drops of knowledge and nuggets. YouTube, I do on Garrett Gunderson TV or Garrett.live in your internet browser. There's my YouTube channel. And then the Money Jesus on YouTube is now up and running, but it's going to start getting a lot of videos coming up.
Amazing. Thank you so much for your time, sir.
Man, take care.
All
Have
right.
a wonderful day.
You too.
Enjoyed it.
This is my time. I'm on the rise. Can't hold me down.
Thank you for tuning in to the Assets and Orthopedics podcast. If you're ready to elevate your mindset, build your empire, and create a lasting legacy, don't miss the inaugural Legacy RX Conference on October 24th and 25th in Indianapolis, Indiana. It will be a transformative weekend designed to help you unlock your potential, take bold action, and redefine your future. Visit LegacyRxConference.com to grab your ticket and join the movement. Until next time, be bold, embrace the hunt, unleash the beast.